Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com. We're into all these topics, looking for potential investment opportunities. I just recently did a Q&A session. We covered a lot of the not questions, but the earnings releases for quarter three for a lot of the companies that we follow. Obviously, there's more being released, and I will continue to listen to all those quarter three conference calls and then pair that up with sector fundamentals, pair that up with ratios that we see in the charts, and then the technicals too. What we're looking for is an alignment between ratios being cheap, the technicals looking good, and the fundamentals that the insiders are communicating to us are in fact good and solid. And there's a lot of information in those that you can get by listening to them. Starting off with Kevin C. Smith, he says, this is Crescat Capital, the hidden secrets of the CAPEX cycle. In the 1990s, extensive spending on computer networking servers and telecommunications equipment infrastructure drove the internet revolution. Aggregate capital expenditure peaked along with the speculative stock market environment in 2000, leading to a tech bust and recession that hit sharply in 2001. In the next economic cycle, capital investments shifted to residential real estate. As it often is the case with speculative bubbles, this expansion hit a debt wall that led to a 2008 global financial crisis. The next cycle emerged with the shale revolution, requiring substantial capital investments to support the U.S.'s path to becoming the world's largest oil producer. Yet this expansion also had its consequences. Oil companies overbuilt and production outpaced demand. That, combined with the slowdown in the Chinese economy that year, led to a collapse in the energy sector in 2015 and a global recession outside the US. Recent breakthroughs in generative artificial intelligence, or AI, have spurred a capital spending race among technology service providers to build expensive data centers and cloud service platforms for AI training and inference services. Some Wall Street analysts are now calling into question the prospects for a meaningful return on investment in the near term for these so-called hyperscalers. Given both high hopes and high valuations for many of these large cap companies after their incredible success over an unusually long cycle that started back as far as 2009, Chris Catt believes there is a high risk of a broad U.S. stock market and economic inflection analogous to the 2000 internet and telecom bubble. I would also agree with that. So this is the S&P 500 index CAPEX cycle. What this is, it's an aggregate trailing 12 months capital spending in USD billions. The chart is as of 10/30/2024. We come on up to the tech bubble, telecom bubble, we pulled on back. We have another housing bubble, pulled on back. We have a shale revolution, we pulled back, and then AI frenzy. And we could potentially see a pullback in the CAPEX cycle. These also correlate, at least this one and this one, I think, with capital rotation from technology into commodities. And then that commodity cycle will run its course. It'll pull on back for the S&P index. It'll probably run late cycle all the way back up until we get another bubble. And it will be a housing bubble, in my opinion, back in late 2020s, early 2030s. That's probably where we'll all peak out. So yeah, that's what's coming, and this is where we're at in this cycle. Ian Castle says stock picking is about discipline, patience, self-awareness, and self-confidence. The first two are knowing what you are looking for and only acting on the great opportunities. The second two are believing in yourself and knowing another run is just around the corner. Well, what I do is I look for alignment, and it's not necessarily about stock picking. Stock picking implies that you're looking at the fundamentals, you're looking at the stocks. You can use technical analysis too, and then you choose a particular stock. I'm doing it a little bit different. I'm looking at sectors and areas, specifically from a macro perspective. I look for what's cheap on a macro perspective for a sector or a commodity or precious metals or something like that. Precious metals and commodities are cheap in relationship to equities. And that's where I start to narrow down where I'm going to look. So the stocks are just vehicles to play the big macro picture. The companies themselves, I'm looking for particular companies in certain sectors. In most of these sectors, commodities related, you're going to get a decline in production of some of the larger producers. And they are fighting depletion in all of these sectors. So what I try to do is I look for high cost producers. And the reason I look for high cost producers, which may be opposite of what other people think, they're the ones that have the most explosive growth. They also are the ones that make more money when the commodity price goes up off their margins. Their margins go from zero to a whole bunch, which means that your returns are the percent difference from where you started to where you end up. So if you started with zero and you divide by zero, which you cannot do, it's an infinite return. High cost producers are also in areas that are growing production. As more and more come online, you have to turn on those high cost producers to produce. So not only can they make a lot of money from the commodity going up on existing infrastructure that they have in place, they can also grow production into a lot of their acreage that they have, if it's oil or natural gas or whatever it is. So those are the ones that generally can grow. So you get a twofold return investing in those. You get the multiple for the commodity price going up and that impact to their bottom line through their margins. And then you also get all of the growth that those high cost producers have if they can grow production. Those will be the most volatile. They'll be the most rewarding in terms of ultimate return over a commodity bull market. But you do have to live with high volatility. If the price pulls up and then pulls back to the high cost producers' price level, you could see very large declines in those particular stocks or equities. And really, what it comes down to is business or balance sheet leverage. The balance sheet is leveraged to the commodity price, and that's where we get the returns. And what we're doing is we're just looking for alignment when everything is cheap to get that big upward move off of the balance sheet leverage. JC Parrott says, it can't actually happen like this again, or can it? So we've got Bitcoin, we've got that rounded bottom and the breakout, and then a rounded bottom breakout and Trump victory at both of those areas. Really what this means is that we've got more money printing coming into the system. So Trump is a money printer, just like all of the other presidents. I can't tell the difference between who's in office because when you look at the M2 money supply, it just goes up. It doesn't matter who's in office. And I think that is by design. The money has to come into the system in order for the system to survive based off of the way it is designed. So it does not matter who's the president, the money system will continue to go up. And Bitcoin's just a function of a measurement of how much money is coming in the system, how much liquidity. A capital allocation from this is, I know he's got Peter Lynch, but capital allocation. So capital allocation, how to think about excess cash. So excess cash generated, that's cash that is generated above CAPEX expenditures. So basically, excess cash above what the company needs in order to run or grow the business. So we reinvest in the business, balance sheet fortification, positive net present value initiatives, investments above internal hurdle rate that strengthen operations or market position. Do we do acquisitions or buybacks? Share buybacks if share price is less than the intrinsic value, or acquisitions if acquisition price standalone intrinsic value and meets our rigorous internal criteria. Or you can do dividends, which is the return of capital to the shareholder. This in the absence of value creating alternatives. So what we see with a lot of these um, companies that are in commodities, we kind of go through this cycle. They start to generate a bunch of cash. The first thing that a lot of them do is pay down debt. That's the first step. They pay down debt, and then when the debt levels hit certain percentages or ratios, a lot of them hit like a 1:0 ratio, is what they generally go for. And when they hit these potential areas, they start to either reinvest in the business to grow it. Maybe it's higher CAPEX for more drilling. Maybe it is acquiring more companies or more assets. And a lot of them, if they've got a lot of excess cash, they'll do buybacks. And the reason they're doing buybacks after they pay down debt and potentially acquire cheap assets is they're trying to reduce the share count. And what that does is that not only reduces the share count, it also increases your earnings per share when you reduce the share count. So as you generate more and more cash, you can shrink the share count down by buying it back and increasing your earnings and increasing your production per share after doing those buybacks. And then you could also get dividends. Now, there's nothing saying that you can't do all of these simultaneously. You can also get a company in a really good commodity. The commodity price explodes to the upside. They generate a whole bunch of excess cash generated. They can pay down debt. They can do share buybacks. They can buy out other companies and pay a dividend all at the same time. And I've seen companies do that. So there's companies out there that are acquiring smaller companies to grow their business. They are buying back shares because they have so much excess cash flow, and they may even pay a small dividend. The transcript. So Druck and Miller on taking losses quickly. It says, if the reason I bought a stock is no longer the case, I don't care what I paid for it. I just don't care what I paid for a stock. It's absolutely irrelevant in terms of my investment process going forward. So what does he do? He sells it and takes the loss. I would be very similar. I have no problem taking losses. I know some people struggle to take losses, and they struggle because they don't want to take the loss. They want it to go back to the spot that they used to. But if you've been in the game long enough, it's like, hey, if this thing's cooked, get out, find something that's a better opportunity, and make your money back on that opportunity over there. Another thing you can do is if you're down on a stock and you aren't liking that stock anymore for whatever reason, you can harvest those losses and put them against gains you have to offset gains. That's another thing that you can do if you can reduce your tax receipt at the end. Peter Schiff says, during his 26 campaign, Trump proposed his penny plan, where he promised to cut 1 penny out of every dollar of federal spending each year. Instead, he added 16 cents for every dollar of federal spending each year. 4 cents if you only count the first 3 years before COVID. So he spent far more money than what he planned, his penny plan, to do. So all these guys, I would say, are spenders. It's by the design of the system. I would not think otherwise. And I don't care if it's Democrat or Republican. They both spend like heck because they have to. It's the only way for the system to survive. It is in the design of the system of our currency. Here's the transcript. Druckenmiller on his advice to young people getting into finance. If they're going in it for the money, they should go elsewhere. There's too many people in this business like me that just love the game and the passion. They're not going to be able to outwork the people that are passionate in the game. And it's not a fun game if you're losing. It's horrible. So that's his advice to young people. Picking bottoms is not our game. Pricing is our game, says Warren Buffett. A lot of people are using technical analysis to try to pick bottoms. I do too, but I also try to make sure that I'm aligned with the pricing. And that's why I incorporate the ratios and also why I look at uh, the fundamentals of some of these companies. I don't want a company that has no way of making money. I just don't want to be there for the long, long haul. Now, there are companies with a lot of assets that are undervalued with the assets that they have, and I deploy money to them. I just don't put as much in them because I want to see cash coming back to me as a shareholder, whether that's through share buybacks or through dividends or something on the lines of that. Cornerstone Analytics says for the past 7 years, we've been bombarded with arguments about oil demand collapsing due to rapid EV adoption. We always said, don't believe the hype, how the pendulum swings. So Toyota executive lashes out at US regulations promoting EV sales. Policies are not in alignment with the consumers, COO Hollis. Company reviewing battery production at North Carolina plant. So obviously, these companies are stuck between these policies that are coming from governments, and then they're stuck between the consumers and what the consumer wants. The consumer doesn't want electric vehicles. The consumer wants hybrids or internal combustion engines for ease of use. Now, maybe there will be a technology change in batteries that allows rapid um, charging, and there is stuff going on with rapid charging. But the one I saw, which was a Samsung battery, it has 1 kilogram per battery of silver. Could you imagine what that would do to silver demand if they started making those batteries with 1 kilogram per battery? Oh my goodness. Chart of the day. The storage withdrawal season has started for the European gas market. The last few days have witnessed seasonally large withdrawals. In August, I warned this opinion column how enough gas inventories could still be insufficient. And that deals with flow rates versus your inventory level. So you could be at you could be at a higher inventory level like we're at today. If we get really cold weather, it's going to drop real quick and could easily go to an area that rocket launches natural gas. So that's the tough part. As demand continues to increase throughout the world, our inventory levels are not increasing at the same pace. So if we were to double this inventory level, what it would do is it would say, oh, you're only half full. Because a lot of people say, well, how full are we? Your inventory should be a percentage coverage of like days to cover. Like how many days of coverage do you have in inventory? And as demand continues to go up, our days of coverage per inventory level goes down. That's what I'm talking about. And as this gets smaller and smaller in terms of days of coverage, your volatility is going to go up in the pricing of natural gas. Olympic Dam is 6% of global uranium production. Let that sink in. And what's happening with Olympic Dam is one of the largest copper and uranium mines, yes, largest for both, in the world and has been offline for almost 20 days. Copper prices are squeezing from the lost production. When does uranium follow? Question mark. Yep. How to Invest by Peter Lynch and his philosophy. So let's just go over this real quick. Philosophy, companies with solid growth prospects bought at reasonable sense. So how to pick stocks, PE below historic average and industry average, a long-term average PEG ratio, which is your PE and growth accounting for it, shouldn't be above 2. Long-term earnings growth rate should be at least 10%. And then you look at how to analyze financial strength. The debt to equity ratio should be at most 1, ideally lower. I would say, a lot of the ones I enter, they're higher than that. They're like at 3 or 4 sometimes. And then they pay down the debt to get below 1. Annual EBIT should pay all in debt at most 5 years. We got favorable characteristics. Institutional ownership is low. Insiders are aggressively buying. The company's buying back shares. The fast growing company is a no growth industry. It produces a product that people keep buying in bad days. Unfavorable characteristics is number 5. Hot stocks and hot industries. It has high revenue, low earnings, and we'll keep going. Stock monitoring and when to sell. Do not diversify simply to diversify. Review holdings in at least every 6 months. Price drops usually should be viewed as an opportunity. Maintain a long-term commitment to the stocks you own. Sell only when the story changes or it becomes too expensive. What I found over all these years, if I'm going to play in just the normal category, the normal stocks that are just all over the place, not necessarily commodity stocks. I'm talking about stocks that control their selling price. I just buy stuff that I can visually see as growing, like the obvious stuff. That's where I've made the most amount of money. Chipotle, I mean, when I was in 2006, I think they went public in '06. But in '05, I ate at a couple of those. And I'm like, dude, this place is way better than everywhere else. So I was like, I'm going to buy a bunch of stock in it. So I did. And I just bought what I saw. And then I started buying Visa and MasterCard in that same era, time frame, just because I used Visa and MasterCard. And if somebody is using it like me, who is really frugal, not really frugal, but I just don't spend a lot of money on stuff. But I use that for buying whatever. I was like, everyone else is going to use this. And everyone was paying gas and everything with their cards. So I was like, man, this is just going to grow. So I just saw things growing. So I bought stock in all of the things that I basically had or were using. I had health insurance. I bought stock in health insurance. I bought stock in my credit cards. I bought stock in places that I ate. I bought stock in um, gasoline companies that I purchased. I just bought stock of everything that I used. Another company that I see, it's private right now, but Chick-fil-A would be another good one. And In-N-Out. In-N-Out's also incredibly busy. They're all going to do incredibly well. Chatted with 2 mates. This is from YYC. He says, white dude came back from UBS China trip. He said, sell all your lithium. There's a supply avalanche coming from China. The Chinese lithium miners come back from Mali site visit. They said, holy crap, it's hard building a mine here. There's no water and no infrastructure. 2 should have talked to number 1. And number 1 thinks, hey, lithium's coming with a supply, avalanche, but the Chinese miners are saying that we can't do this. So there's a disconnect between what people think and the perception versus reality. Trump is planning to exit the Paris Agreement and run with fossil fuels, primarily natural gas and nuclear. I think natural gas and coal worldwide are going to fill the gap, and then nuclear is going to come later. Morgan Housel, quote, read last year's market predictions, and you'll never again take this year's predictions seriously. A lot of people are making a ton of predictions. I know people put a lot of weight on those predictions, but guess what? A lot of them are wrong. Wrong, 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 wrong. So what do I do with predictions? Absolutely nothing. What I want to see is I want to see the technicals, and I want to see people positioning in the stocks with good technicals. Then I look at the size of the technicals, and then I look at the fundamentals, and I go in and do all my fundamental analysis. And then I look at the sectors too. I'm not going to go into something just because of prediction. That's ridiculous. Money wisdom. The world is split between those who don't know how to start making money and those who don't know when to stop, says Nassim Taleb. HFI research, the peak in U.S. oil production is here and why you need to own energy stocks, in his opinion, or her opinion, whoever it is. Says the tide is changing, it's finally here, and I suspect the timing couldn't be any better. Just as everyone buys into the idea that President-elect Trump will somehow promote drill baby drill, U.S. shale crude production is all but plateauing right in front of us, says HFI research. Now, this is what I will say. I think that the shale is plateauing. But I won't say that it is. Like, I think it might be, but I don't know for sure. So, how do I know, or when do we know if it is actually plateauing? We need the price of oil to get above $100 a barrel. Then we need to see if the plateau is legit. So, it's not about having an opinion, it's not about having a prediction. It's about getting the right market conditions to occur and then seeing what the reaction is to those market conditions. So, what I will say is, I think it could be plateauing, but I'd like to see oil go above $100 a barrel and then see if production actually peaks. And then you have to define what production is. Are we talking about oil production or are we talking about all liquids produced? I'm talking about oil production, not all liquids produced, because we could still see natural gas liquids go up and lighter nat gas stuff still come out of the shale, maybe in greater quantities. But oil, I do think it's going to struggle to go up. So that's where my opinion is. We need to see pricing go up and see if we actually plateau. Brady says silver's having a perfectly normal pullback right now, and big picture, here's why it is churning right here. Says for silver, the big breakout level using the yearly time frame is 31.32. One of the most significant breakouts in history is coming for silver, and that's exactly where we're at, right at that resistance. What he says is this is the mother of all probable cup and handles. The bigger the base, the higher in space. Fractal, smaller cup and handle. We got a big one on our hands here. And we're about to close on a yearly candlestick, maybe, depending on where we close, on a breakout for silver. A yearly close breakout. HFI Research says Chevron and Exxon on the Permian, two oil majors with the ability to rapidly expand production, but are choosing not to. Why? They need to maximize the value of the assets. And as we move towards the 1 million barrel a day mark next year, we will begin to shape our profile. There is a little bit towards a plateau, and we really begin to focus on free cash flow. And so growth will become less the driver, and free cash flow will become more of the driver, if you will. And that's from Chevron, I believe. Coming over here, Darren Woods says, yep. It says, yes, I would just say that the focus of the team is net present value and maximizing net present value. I think the drive, like we've always said, it's not a volumes gain here. It's a value gain here. And the great news is we're seeing a lot of value. So that's what they've been thinking, potentially plateauing in Permian. And that's what I've got for today, guys. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got that May Day coupon code, 50% off the first month and only the first month. Or you can sign up for the yearly membership and get a larger discount. Even if you're already a member on a monthly membership, you can always go to the yearly, use that discount code for further savings if you'd like. But that's what I've got for today. We'll catch you next time. This is Finding Value.